How do you think about like kind of the future of this diaspora of venture capital?
I certainly didn't invent this in DC, but Revolution's rise of the rest, I think, is sort of one of the kind of catalysts for this movement, at least the way I think about it here from just my
What was
own
that
kind of
phrase? Revolution to rise to the rest?
so
What?
Revolution has a fund called Rise of the Rest.
Oh,
And the Rise of the Rest fund is the thesis around Rise of the Rest is
oh,
simply, it's not SF and it's not New York, it's every other market. And
right.
every other market, there's all sorts of things. If you look at the stats on employee retention in markets that aren't SF in New York, they're considerably better
Yep.
because Salesforce having a headquarters in Indianapolis, a big office in Indianapolis. If Salesforce in the early days had a few bad quarters, no one was jumping to the next startup next door because they just didn't exist. And
Right.
so you actually had better employee retention in these places. Cost of living was lower, and so you could build businesses cheaper there.
Hey everyone, welcome back to another exciting episode of the Ignite podcast. I'm your host, Brian Bell, as usual. Today we're delighted to have Matt Gittleman on the program. He is a VC in DC, which I love. That's his headline on LinkedIn. Thanks for coming on the program, Matt.
Thanks so much for having me. Excited to be here and excited to have a good conversation.
Yeah, these are some of my favorite podcast recordings, having a fellow early stage investor on. We can talk a lot of shop, and I think the audience gets a ton of value. I would love to get an intro from you for the audience.
Yeah, I'm happy to do that. My name is Matt Gittleman. I work with a sort of single family office. I always say that family office is a bit of a generous term for kind of what I'm doing because I really like to describe my role as the GP of an Evergreen micro VC,
Hmm.
which is to
Yeah.
say that we are doing a lot of early stage venture deals. And so when I joined 2 years ago, there was already over 100 active portfolio companies.
Wow.
We are up to about 130 or so now. We're doing about 10 to 15 deals a year. We write very small checks, 25 to 50K, which really puts me pretty much the smallest investor in almost any room
Yeah.
I walk
I'm the
into.
same. We're the same at Team Ignite, almost exactly the same. Yeah.
And I love that. I mean, it means
Yeah.
you're never oversubscribing around. You can always be a sounding board to the investor. You're never dictating or driving terms in some way that's not really in the best interest of the founder of the company. And it's sort of a fun place to play. And that means when a round comes together and it's $1 million, I can put in my 25K check and it's 1,025,000 and no one really bats an eye. But we can also help put together SPVs, and so that SPV is 100 to 200K, or we can kind of flex in different directions around that kind of pre-seed, seed, and Series A kind of stages. Yes, I'm here in DC. I spent 4 years prior to this role with a group doing early stage cybersecurity investing, and that was Series Seed, Series A. That group is called Blue Venture Investors, and they do a lot of they like to do a lot of follow-on investing on top of that, and so they also have a $25 million dedicated cyber fund, which I worked with for about a year or so before coming over to this family office. I did get my my start in the industry on the startup side. I spent about 7-8 years working in venture-backed startups between DC and Boston. Really kind of caught the bug, I'll say, kind of doing that. I worked for a company called LivingSocial here in DC, which was sort of the daily deals business.
Oh yeah, Living Social. Yeah.
Days, 2 for 1s at restaurants, and absolutely loved that work. I was probably employee, 50 to 75 or something. They grew to, I want to say, around 6,000 and contracted in that same time frame down to about 3,000, all in the 3 years that I was there. So just meteoric growth and a little bit of
Yeah, what was that? I mean, the group on Living Social thing, like everybody herded into that for a while and they were just riding high and everything was crazy and then it contracted. Like what was that market dynamic?
I mean, it was sort of unlike anything else I think we'll see in most industry for a long time. I mean, it was cohort classes every week of 20 or 30 new employees every single week in various offices, 20 or 30 per office, right? I mean, I was in DC. I worked in 4 different office buildings, sat on 5 different floors, had 4 different managers, and probably about 6 different desks all in a 3-year period on different teams. And it showed me how much energy and excitement can exist within a startup community and the startup world. The amount of companies that have spun out of LivingSocial and the sort of success that they had in those early days was so important for this ecosystem. And it's not that every company is now a offshoot of what LivingSocial is doing, but there are so many great entrepreneurs in this ecosystem. Susan Tynan at FrameBridge, Rachel Lubin, who is my manager, is now with a company called Rhoda, which is in the car maintenance kind of space. there are so many that are doing really interesting things in and around this space. So we owe, I think, a lot, this community does, to what LivingSocial built. It was probably the next thing that came, honestly, after like AOL, right? There's been others
Yeah.
after that and before that, and all over the place. But LivingSocial was a big part of, I think, that probably 10 years ago. I spent 3 years there, all sorts of different roles, kind of caught the bug. I moved up to Boston, worked at a couple companies up there, one called Yesware, which has a sort of interesting VC connection story for me there. And then a company that at the time was called Hourly Nerd, and it is now called Catalan Technologies. But Hourly Nerd was started out of a Harvard Business School classroom by a few guys who did it as a class project, basically connecting MBA expert talent to small and medium-sized businesses. And that grew into what is now a fairly large company at this point. They've gone through Series D, E, and maybe even another one beyond that. And they are servicing the Fortune 1000. And so it is in some ways a replacement for some of the major consulting firms out there. In other ways, they've added software that allows them to aggregate all of their kind of consulting spend and all the deliverables, and just creates a little bit of transparency around a world that's a little bit of a black box. So they've really done a fantastic job. And that was where I really decided that I wanted to get into venture. So I saw the sort of skill sets of the founders there, the questions they were asking. It's where I wanted to get into venture. It's where I wanted to go back to business school. And so came back to DC, went to business school, and at Georgetown here in DC, and had this tremendous opportunity through a program they call the Venture Fellows Program to spend a year working with a venture capital firm. And so coming out of the MBA, I had a year of experience. I worked with a firm DC called Core Capital Partners doing enterprise SaaS investing, got to know some really great people, and was fortunate enough to find a role doing early stage cyber investing right out of the MBA. And so I did that for 4 years before being where I am now. And love the kind of generalist approach, and have a lot of themes that I think are more interesting than others. And we can certainly get into those. But that's kind of the story about kind of where I am now.
That's amazing. And what was that bug that caught you about venture? What was that transition like? It sounded like you were at some startups and you kind of got pulled into venture. What was that story?
Yeah. Well, my first kind of interaction with venture was one where I didn't even recognize what it was. When I was at Yesware, one of the investors was Brad Felt. And so he was on the board and came by to our Boston offices and sat down with some employees for lunch. And I happened to be one of them. And I kind of just thought to myself, man, who is this guy? I'd rather be having lunch with my friends, my colleagues. And, I sort of later come to realize that was sort of one of my first real interactions with a real life venture capital investor. And looking back on it, I remember, how many great questions he was asking. It was, it was not, board level conversation. It was just kind of trying to understand work culture, right? It was trying to understand the people that worked there, how much they liked being in that kind of professional setting. And it was just a data point for him.
Was that before he made an investment? He's doing due diligence?
No, he was on the board. He was on the board. It was just, he was there for a board meeting, maybe that night, that afternoon or something. And for lunch, he just wanted to sit down with some of the employees. And it always struck me as I look back on it. At the time, I didn't even recognize really what was happening, but I'm sort of grateful for that kind of that story, that looking back point to be able to call back on. But it was really kind of coming into the MBA. I realized that the thing I liked most about startups was those early days, the big challenges, the fail fast kind of mentality, let's keep trying things, like the tenacity, the grit, and of course that never changes with companies that are successful in the Series B, C, and D and beyond. But those early days is where there's a lot of very high impact problems and very high impact solutions to those problems. And you can kind of A/B test a lot of them. And those are things I always loved doing when I was working in startups. But day in and day out, I have the absolute privilege of getting to talk to startup founders who are dealing with those exact problems day in and day out. They get to teach me about the industry that they're working in. It is a lifelong learning type role. And I just absolutely love that aspect of it. So getting to spend time with those early stage startups that I love so much working for day in and day out, without them ever, they fully grow up and then they go on to someone else and get bigger investors. And I love that. That's great too. But it's been it's been really fun getting to help them solve those early problems.
Yeah. So what was that transition like from, what was the last kind of operating role to that kind of first, I guess it was associate at Blue Ventures kind of role?
Yeah. Well, I I think it's a great question, because the difference between working as an operator, especially in a marketing or kind of operations kind of capacity, to a venture role, was actually really challenging at first,
Hmm.
because I lived every day, every week, every quarter through a series of KPIs. How many marketing qualified leads
Right.
did we generate? How many of those qualified leads went over the sales team? How many of those did those convert? Everything was measured in minutes and hours and days and weeks. And in venture, I looked back at the first 2 or 3 weeks of what I had done, and I thought, what did I do?
Did I
Right?
do anything? Yeah.
Right. What is it that I am doing?
I looked at some decks. I met some people.
And
I
that
read
is
some memos. I wrote some stuff. Like what was that?
and that's everything, right? And especially as you're learning and you're just trying to get some reps in, it's that is so much of it, right? It is looking at deck after deck after deck. It is talking to investors and founders as much as you possibly can. It is building up a network of relationships that are not just superficial but actually kind of meaningful, where people understand what it is everyone's doing, right? And so if I can better understand what you, Brian Bell, are looking for and doing, we're going to have a more meaningful relationship than if we just have a quick casual conversation once a year and when we run into each other. And I really I looked at those first few weeks as okay, how do I measure success in this role? And in some cases, you actually won't start measuring any success until you start picking deals and actually
Yeah.
investing your money or someone else's money in those deals. Even through my time at Blue Ventures, I was not on an investment committee. I was not making investment decisions. I could certainly put in long hours on a deal and try to push it through and get feedback and get support from our partners, but I was never the one actually making those decisions. And so in some ways, the clock didn't really start until I joined this family office, Jay. In other ways, I think the reason I have this opportunity is because I was doing a great job, I think, with Blue Ventures, right? And so the success is measured, I think, in different ways. But I did as best of a job as I could of building up a network, proprietary deal flow, which is like what everyone likes to talk about. And
Right.
it's not that I'm the only one seeing these deals, right? But it's that the combination of all these deals together, hopefully, I'm one of the only people seeing in that exact capacity, right? And it's being able to articulate the types of investment opportunities that you're looking for so that you can look at higher quality deals, not just more deals. And all of those things, I think, are things I tried to hone as much as I could at Blue Ventures. And also you get to know the likes and interests of the things that the IC actually wants to then invest in. And so you can start to bring higher quality deals
Yeah.
and passing on the ones that are not going to get through the IC. And of course, we're going to get lots of things wrong. So I call deals higher quality or lower quality, but I could give you the sort of a couple companies in sort of our anti-portfolio where I know that
Oh
Blue
yeah.
Ventures just missed tremendously, right? And that could have been my fault. It could have been the IC
Yeah.
deciding not to, but ultimately we didn't invest. And then in others, I might not even like the deal, but I brought it forward anyway, and it's gone on to be a big winner. And so we try to have a higher hit rate than not, but those are
Yeah.
certainly going to be situations that happen across the board.
Yeah, that's so funny. I mean, I've had the same experience. 140 portfolio companies now, over 6-7 years of investing, and lots of anti-portfolio companies I should have invested that I missed in a variety of ways, and lots of companies I should have passed on. That I did invest. The old phrase is like it takes $10 million to make a VC. And I depends on how many investments you make in that 10 million, but I think it's probably a number of investments. It's probably a few dozen. Somewhere between 30 and 50, where you're kind of like, okay, I kind of know what I'm looking for here. Walk us through kind of that process, right? I mean, you guys are investing in 10 to 15 a year, it sounds like,
Mm-hmm.
kind of small checks. We're similar. You're getting a lot of deal flow in your inbox. How do you triage that time and look through all those decks? And like, what are some green flags and red flags that you've tend to gravitate towards now that you've looked at, probably thousands of decks like I have?
Yeah. There's different types of green flags. And I think the green flags you see, well, the reasons to look at a deck are fairly determined by the type of firm you work with and you represent, right? There's an investor here in town who has a fairly large platform. It's a national platform, and she will look at basically any single deck that comes into her inbox and spends a full cycle on it, and they have the resources. Maybe her, it's maybe someone else to actually do that.
Yeah.
I can't. I'm a team of one. I've got
Right.
no support staff. I work for one person, one family, and I invest on their behalf. And so try to look at as much as I possibly can. But the more I can get a warm introduction, someone, if it's a cold inbound, it is very unlikely I'm going to spend very much time on it. I'll look at the bullet points. I would always expect and look for, a really good, short, concise deck, and then 2 to 5 maybe really good bullet points about where the company is and where it's kind of going. And those are really hard. It's really hard to capture folks' attention in that short amount of time. And sometimes it works. And sometimes it's about, just talking about the type of industry. I can talk about this we've talked about this earlier, the kind of theme around our thesis, which I like to say is around hyper-contextualized data. And so if I see a company that clearly is operating in some form of this kind of verticalized data solution or data builds and data plays, I'm probably spending the first minute on it instead of the first 30 seconds on it. And then that minute hopefully turns into 30 minutes and then a conversation. More than not, it's about talking with folks like yourself and other folks in my network and saying, hey, this is what I'm looking for. Yeah. And then they say, you know what, that's kind of interesting. I've actually got a company maybe you should talk to. They're either going to go out for a raise in the next few months, or they're raising right now, or they're not raising at all, but you should probably just talk to them anyway. And so I think that most of the deals that I spend the most amount of time on are sometimes for the purposes of continuing to build that relationship with that other investor. And I can go back to them and be candid and say, listen, this is probably not a great fit, and here are the reasons why. These guys are raising at a valuations just beyond what we're comfortable with, and that's fine. I'm sure they'll be successful in their own right, but that's just not for us. Or, I would love an introduction, right? And I think that the way I triage is trying to do that first pass on as much as I possibly can, as early as I can. I do work with interns every once in a while, and if I get a list of 10 or 15 companies, I'll say, hey, go through some of these.
Yeah, go through them, yeah. I do the same,
right? And see if there's anything that's interesting. And that's in some ways fair and sometimes not fair, right? Because the interns do not have the same pattern recognition or thesis builds that I've been doing over the last 5, 6, 7, 8 years.
Right. I feel exactly the same way. We run a pretty large internship program, and I actually don't have them do the deal screening because they just don't have the at bats. It's like asking like a minor league batter to step up to the majors and take some swings at pitches. They just don't know what they're looking for. Like they just haven't seen that kind of breaking ball or that slider, to tug on that analogy. Yeah. Whereas like, somebody who's a major league batter, they're waiting. They know what pitch they're looking for, right? To kind of just tug on that analogy. Like I just know how that ball's coming in, and I'm going to take a swing at it. Versus somebody who's just kind of learning how to hit off the tee ball, right?
I think that's a very good analogy, and I wish I was able to. I think the reason
it's hard to articulate this, right? It's hard for people who aren't in the industry looking at hundreds and hundreds of decks every month. It's hard to articulate what we see that makes a good deck, right? It's kind of a little bit of everything. I like to describe it as it's like every startup's like a beautiful snowflake. Yeah. Right. And I'm kind of trying to find that unique crystalline structure that's unique to that startup. And it's nothing in particular. It's everything in particular, but nothing in particular as well. Because you're kind of looking at the whole picture. Yeah, you got to have traction, right? And you got to have a great team. But then you're kind of like you said, sometimes you're this is the 50th, remittance startup I've seen. And, why is this one going to be any different than any of the others? What's unique about this? Oh, they have blockchain in the middle. Okay, great. Who cares, right? Yeah. So stuff like that. And so you kind of you build up a lot of PTSD. Yeah. Looking at lots of these decks. Yeah.
Well, I think that's interesting that you said about that sort of being a beautiful snowflake. I go to founders and they say, what makes a deal better than another? And I've always kind of used the metaphor of levers and hurdles, and they don't quite match because one's, running and the others, just general physics here. But if you've got something that really works for you, if you're a repeat founder, if you're building in a really massive space with some sort of great efficiency that you're creating, pull on those levers, right? Those are the things that should be front and center on your deck. And the reason every deck is going to be so different is because
exited also for 100 million. My last startup raised 20, exited 100. Okay, I should know that on the first slide, basically.
Yeah. And I think one thing we actually really rarely see is a founder who says, hey, I'm a serial entrepreneur. I've had 2 or 3 successful exits. You never see what those exits are. You very, very rarely see what they are. Yeah. And so I think, that should be in more ways front and center. But then the flip side is the hurdles, right? How do we lower those hurdles so that we can still get through and get this deal done? And so that hurdle might be that the valuation is too high. The hurdle might be that it's pre-revenue, but product is built. All of these things become hurdles for us to overcome. And so that those levers that you pull on in terms of how you understand your customer, what the product roadmap looks like, who your pipeline is. I'm making an investment in a company right now where they're pre-revenue, but they have a relationship with actually a law firm that is in the business of helping them get introductions to their own customers, to the law firm's customers, and they're an equity. They actually hold their vesting equity into the business as a result of those introductions, and that is a just hugely valuable sales kind of channel for them. They're
Right.
also
They got a
directly in the same
distribution wedge
space.
here, right?
Okay.
Yeah.
And so, the product is interesting, but the founders are more interesting, and the relationships that they've got with this law firm, with this channel, this distribution partner, are more interesting. And so the product, which almost is the hurdle, which is kind of interesting, is the thing that I can now get over because I like everything else about the deal.
Right, because it's not always the best product that wins, right? It's in this case, it might be that distribution advantage, it might be this team, or the timing, or the market. Maybe you could talk a little bit about, I love this concept too. This hurdles and levers. It's kind of like pluses and minuses, right? Like you have these things you have to get through over. Hey, you're pre-launch, right? That's a huge hurdle for me personally. Like maybe you could talk about like if you saw a pre-launch company or pre-revenue. Maybe they have some POCs, they have some free users. What kind of levers do you have to see on the other side to kind of get you over those hurdles?
Well, I think those levers are really can be almost anything, and it's just a question of how hard you can pull on it because of how strong you are in that category. We're making an investment now in a company that I can't even fund them yet because the bank account isn't set up, and
Wow, that's really early.
It is really early, but it's because of the relationship we have with the founder and how long we've known this founder and how much we believe in their connections in this industry and how they're going to be able to be the ones to succeed in this. Terms are good, all of that. So, it doesn't have to go that far to be in this category, but I actually don't think, I think it's going to have to go really far. It's kind of one of these binary ones. It's either going to be huge or it's not going to really kind of take flight. But we're doing that because of the founder. It's founder, 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 founder in that one. And it's not to say that founder could go do anything, but it's the founder market fit, right? Like the founder with the market and the connections they have in this space are so strong that we're willing to take an early bet on this company. Wow. And in some cases it'll be the founder. In some cases, I'm trying to think of another.
Well, let's think about like red flags, other hurdles, right? You got this pre-launch, pre-bank account example that I love that, right? I can't even wire the money. I believe in the founder so much I can't even where do I send the money? I'm ready. What are some other hurdles that are common that you sometimes take a pause and you have to kind of look at all the other pluses?
I think the easiest one is lack of transparency and is over promise, under deliver, right? Like the second you see a number in a deck and then you kind of realize, well, that's actually like 50% of that or 75% of that is services revenue. It's not really exactly where you're saying it is. I mean, the second you start getting disappointed about any single bullet point, you start losing steam really, really fast. And so it feels like it's not complete. It's not lack of transparency.
It's not like they lied to you specifically. It's just that they obscured the whole truth.
Right. I want to build an excitement, not decrease excitement, right?
Right. I should be more excited. I had a deal that we're looking at the other day where, on surface, it was pretty good. Like it's not an easy yes, but like we're kind of like, we're liking it. And then, as we dug into the due diligence in the investment committee meeting, we just liked it more and more. We just kind of kept like, okay, that looks better than we thought. And then like, oh, that looks better than we thought. And like it's building excitement in the meeting because the more we stare at it, and this is not usual actually. Usually you're staring at a deal and it gets worse, like usually it kind of like cascades down, but this one's cascading up, which was really unique. And we're like, okay, well, we should make the bet, maybe we could talk a little bit about
actually I'll kind of give you an example here. We invested in a company back in December of 2023. I had actually said no to the deal. I said valuations too high, I can't get there. Had the very good fortune of finding myself sitting at dinner with this founder at sort of a pitch event. And he said, a lot has changed. Like we're still raising on the same terms. And I said, oh, that's great. But what he said is that what they were once doing with just kind of sensors, and they were basically tracking and monitoring, the sort of freight that drives by these sensors. He's now able to pair with all this third-party data. You go, wow, okay, so you're not just seeing this freight one time. You're seeing this freight every single second of every single day through other means. And you don't know exactly which truck it is or who it is, but you're able to create this fingerprint to be able to understand movement of where this is going. And I immediately realized that the opportunity became that much bigger. And so I started, I went from first to no, right? But then as I went back into it and I said, man, I just don't know if I can say no to this. And I kept from there, that moment was actually pretty rare when you actually do get to a no because of one thing, but you realize that the upside opportunity and the way that they were building the product added in layers of moat and a barrier and of growth opportunity, and a value to an end customer, right? It was the value to the end customer that really drove everything there for us.
Yeah.
And so I'm really excited about where that company's going. And that one was that one where sort of started with a no, but then built excitement with every single interaction after
Yeah.
that. And actually, I think that speaks to another story of meeting founders in person, right? Like for a 25 or 50K check, it is sometimes very challenging to do that,
Right.
just from a cost perspective.
Yeah.
But it can change everything. It can
Yeah.
change, the types of things you hear from them. It can change like your views on them and the types of kind of just back and forth you have. So I think it's really important to, this being a relationship and people driven kind of world, not meeting people in person can be challenging.
Yeah, what I've started to do is I'll try to get them on the podcast as soon as I can before I wire. It's been
Okay.
like a little hack I've been doing. So a lot of folks you see on the podcast, I'm actually in due diligence with, and I haven't actually signed this A for wired money. That's actually another just awesome way to spend an hour with them and just kind of see them, on stage basically
Yeah.
on the podcast.
It's a
And
great platform to use.
yeah, yeah, I have a story like that as well where I passed on something, I just wasn't sure it was going to work. I was like, it feels kind of nichey, but on good terms, like, hey, it's a little too early for us, blah, blah, blah. Stay in touch. Let us know how it can be useful, the standard VC decline.
Yeah.
And it was actually VC friends like, hey, remember that deal? Like that one's like really catching fire. I think they just like 15x revenue year over year, I think. And there's, I know you're a small check, so you could probably still get in. And sure enough, reached out to the founder, got in our little 25K check, and that one's just off to the races, right? And it's a really good example of like sometimes in this early stage game, and maybe you have some stories like this too. Like usually there's 2 or 3 rounds before you get to A. Now, right? You got your pre-seed, your seed, and in most cases now a seed extension. You basically are raising 3 series seeds before you get that price to A at this point. And so as a multi-stage kind of pre-series A investor, you have 2 or 3 shots on goal in some cases to kind of see how the company's developing.
Yeah, I think that's absolutely right. I kind of wish it wasn't right. I think if you look at the story of, I think some of the most successful companies, you can call me kind of a simpleton for this, but I think like the more vanilla the story is, of up and to the right of pre-seed, seed, series A, the more likely that everything has been because everything has been going right. And so I really look for those opportunities where I feel like that is going to be the case. But having said that, a lot of my first interactions with the company are on the round after the seed and before the A, right? Because it's really hard to find a company at that pre-seed or seed stage level because they haven't been written about. They're not in TechCrunch yet. Like PitchBook doesn't have great data on them yet. All these other platforms.
This is where the deal flow really comes in. That proprietary deal flow for early stage investors like us is so important. Like networking, like we're doing now, and sharing deal flow. And it's really a team sport, which is it's really fun to be a pre-seed seed investor because you don't necessarily. It's not a winner take all kind of Series A, B, mid stage kind of thing. It's like, hey, I'm writing a 25K check. You're writing a 25K check. What have you seen lately that's interesting? Here's what I've seen. And it becomes this like team sport. I mean, every once in a while you get a sharp, elbow from the top ropes, to use a wrestling metaphor, from, A16Z that comes in with their $5 or $10 million check. And they're like, gosh, crush everybody out. Maybe you could talk about that. Have you been pushed out of some rounds that you wanted to get in? And like, what was that experience like?
I have not in this new role. With the family office, our check sizes are such that, usually I'm talking to them at a moment in time when, no matter how much oversubscribed the round is, like I can still have my little 25 to 50K kind of carve out, assuming that I continue to build that good relationship with that founder. And it's been a really unique place to kind of sit in the market because, I got an email today from a company that said, hey, by the way, we filled the rounds. And I don't know if I was going to do the deal anyway. I was, it was not one that I was super excited about. And so now I'm not going to do more work on it, and that's okay. And I'm super happy for them that they got, what they need. And I think that's probably the most important thing here because, this entire role is, of course it only exists if we're able to make money on it. But I see the mission part of it is just helping these startup ecosystems, thrive. And, the future
Yeah.
of, of the world and this country and everything in between is contingent on the right ideas and the right founders being funded to do that. And so, it only works because we're able to, hopefully see some returns on it ourselves. But the reason we're there is, is for the reason we exist is actually for other reasons.
I've personally missed a few rounds that I wanted to get into. My due diligence process is longer than it should be for a 25K check, and the round will fill up. But inevitably, I'll just stay in touch. Sometimes I'm able to kind of get in and be like, hey, what are the terms? 25K check. But if I stay in touch, usually in a year or two, I can get in. Maybe I missed out on like a 1.5 or 2x kind of markup, but I can typically get in again, right?
Yeah.
If I stay in touch and I'm useful, put them on the podcast, whatever.
Again,
Let's talk about
always a great lever to pull on your part, right?
exactly.
That's a lever for you.
It is. And it's my favorite part of my job is why I do the podcast, right? Just talking shop to other VCs, learning about founders and their unique take on the market and technology and all that stuff. Let's talk about valuation, right? Like you mentioned valuation a few times. What is too high of a valuation for what you guys are looking at? Or is there some kind of ratio between ARR and that multiple, or how do you guys think about that?
Yeah, I mean, like the easy answer is that there's, it's a revenue multiple, but it's a really unfair conversation to have when you're talking about certainly a pre-revenue company. Obviously, it's not even possible. But also, really, any company under $1 million, it's almost impossible because the multiples just jump so fast, right? As soon as you hit $1 million, it makes sense. I get it. I think we look at, again, it's levers and hurdles, but it's this pre-seed and seed stage rounds. We're probably looking at a sub 10, and then it's all based on factors beyond that. Right. So that's kind of our goal. I think, in the last 2-3 months, I've seen 2 million, I've seen 5 million, 6, 8. So it's all really in that kind of sub 10 range. We certainly pay above that too. And we recognize that, there's this really sort of delicate mix or important kind of balance of if you're paying so little for a deal, well, why are you paying so little for it?
Right.
It's the classic kind of a VC dilemma of like never investing because valuations are too low, so there must be a problem with it, and valuations are too high, so I'm not going to do it. And so threading that needle, I think, is always a challenge. The data is all out there, and so it's I'm not reinventing the wheel in terms of like what we're comfortable with, but we will invest usually in a sub $10 million valuation if we can. If rounds creep up beyond that, it's because there's things around the deal that we really like in other ways. It's the founders, it's the market, it's the product. Those things are just that much better than other things we've seen, and so we're okay paying up for it. A lot of times it has to do with go to market, right? Like that there's a great pipeline there, that they've got great customers on the other side of this thing. They just need cash to go get it. But then in other cases, we'll pay considerably up because we view this as a much larger scale outcome opportunity, right? And it's a little bit more binary. And so, the more you can really sort of fight on those. I mean, someone was asking me the other day, we did a deal at about a $12 million valuation. When we could have maybe waited a couple months and did it at about 25, which has now happened as well. And it would have been a lot easier to be part of that $25 million round. And really for us, the outcomes feel very binary. It's like the company's going to be either worth $10 billion or it's going to flame out in the next 6 to 12 months.
That's a very good venture deal. Your standard VC would tell you like that's what they're swinging for the fences, right?
Yeah, absolutely. But then so this person asked me, said, well, why like try to push this through so fast when the outcome is so high? I was like, well, for our check size and the amount we're going to put into this deal, it's a $40 million outcome at a $10 billion valuation, or it's an $80 million outcome. And so you're 2xing at every single level. It's very simple back of the envelope math, lots of complications around dilution and all this kind of stuff.
Yeah.
But 12 and 24 or 25 is going to be the difference in 40 million or 80 million at our sort of top end, market potential here for this company.
Right.
And so, discounting, down to 40 million from 40 million or 80 million based on probability of this actually happening changes it maybe from a, $5 million outcome to a $10 million outcome.
Right.
And even that is a huge, huge difference. And so, if you look at that in the scheme of our entire portfolio, we do want to be optimizing towards lower valuations as much as we possibly can. 12 and 25 are pretty big different, there's a pretty big spread there. But the same goes for 5 and 7. And so while it doesn't seem like a big deal at this point, it actually is fairly significant at exit, depending on where those exits end up taking place. Because most exits aren't 10 billion, right? They're 50 million or 100 million or
Right.
150 million.
Yeah, the average, I looked this up, the average, because I do a lot of B2B SaaS, the average B2B SaaS seed stage company takes 9 years to exit, and they exit at $249 million. That's the data.
That
So that's the
feels
average. And obviously there's a huge, variance around that mean, but, so you have to be, thinking about that as you invest in 50 cap companies. What's the probability this 50 cap company even gets to 250? It's pretty low, right?
Yeah, it is.
And there's a power law at place, and you're trying to kind of look at the whole market as a VC, and it's a little tougher as a generalist. Like I'm a generalist B2B SaaS investor, because you're kind of looking at, okay, I'm looking at this company and it's priced fairly high. Yeah, it's an amazing team with lots of traction, but is there another team with lots of traction that I can get in at a 10 cap versus a 50 cap, or a 5 cap? Because now if I can get in at a 5 cap and they go 10x and they exit for 50, what's the probability that 50 cap exits at 500? And those are the decisions you're making in your portfolio construction, right?
Absolutely.
I love that. And you have your deal evaluation scorecard on the website. I was kind of checking you guys out before the recording, which I love. I have the same thing. I put it out there on Substack, and it's team, traction, technology, TAM, and terms. And you have a weighting, which I like. And so talk us through that framework and how you guys evaluate. And it's a weighted scorecard. You're giving these like a 5-point rating. Walk us through kind of that methodology.
Yeah, I will say like the rating on there. So those 5 T's are really from actually some work that one of the partners at Blue Ventures did when I was there. And so this is not my framework. I do follow this framework in a lot of ways. I wouldn't say I put together an Excel spreadsheet or
I mean, I'd be lying to say like if my framework's unique. Like I have 17 or 18 things I look at, and I've borrowed everything from other people over the years, right?
But it's things you like and respect and understand and think are drivers of successful businesses, right? And so I put that on the website. I think because it's not usually very well known, right? Like what are the things that startups that investors look for in a startup? And so I wanted to just add a little bit of transparency to our process. It's not to say that if the terms are really the driving force behind us even taking like a second meeting. Like if someone says, "Hey, we're raising 100K at 2 million," I'm gonna go, "Okay, well, let's have a talk about that." And it may turn out that the product and the team just aren't quite there, or there actually is a deal at a 100K raise at 2 million that I probably just missed out on because I was a little bit too slow. But 100K at 2 million, you don't need too many supporters to kind of wrap that all up. And so
right.
I think I'll have another shot or two at that company after I've seen a few more kind of cards played to borrow more metaphors here.
Yeah, there you go. Yeah, I like that.
But
let's see the flop.
Yeah, exactly.
I'm gonna check and see
flop
the flop.
Is also a funny word for a startup. Seeing more cards. I definitely use that in sort of the back of my mind, but it's more about just trying to give founders a little bit of insight into kind of what the process looks like, maybe for me and for others. And the reason there's ranges in there is simply to show that no one's going to be the same. Your particular deal won't be the same, right? Your particular company is not going to be evaluated the same way another company might be evaluated. We may weigh the team more highly for this company than we do for others because they're so strong. And so it's just trying to be a little more transparent.
Yeah, love that. Well, so what's next? For this family office, you guys, it's an evergreen family office. You said, like, what's the vision for the future? Is it just keep investing early stage, small checks for the foreseeable, or what's happening in the future for you guys?
Yeah, I mean, I did not start this process. I didn't come in on day one. The family that I work for has been basically acting as an angel investor for 30 years, and so that will continue. Wow. One of the things I came in to do was to create sort of process. I kind of, as I called this earlier in the beginning, kind of an evergreen micro VC, right? Like, but that evergreen micro VC before I started was operating out of Excel spreadsheets in an inbox, and so I've tried to implement and institute sort of things that you would expect from an early stage VC fund, whether it's just CRM or it's portfolio management solutions and sort of everything in between. So it's that kind of cohesiveness that kind of is required, so that I hope to keep doing this for quite a while. But I also recognize that I could take what I have, it's in a box, and say, here it is, go with it, right? And that could mean hiring someone so I can do other things, and this as well. It can mean some other structure. I mean, that the future here at the family office is almost certainly to be very similar in terms of an investment structure. We're going to keep doing deal by deal evaluations. We're going to keep investing at a pretty good clip. It may go up and down in some years depending on some other factors, but for the most part, the thing I think that they have been so successful in the 30 plus years that they've been doing this is really almost less about choosing the exact right companies, but it's about choosing the right thesis, and it's about consistency of deployed capital. So that in up years and down years, you still have companies that are starting the clock on that. You said 9 years or 9.5 years. Our number is 10.4 years. That is the average time to exit of our portfolio.
Wow.
And so, with a portfolio that is now 30 years old, you have every single year companies that are hitting that 10.4 year mark. And so you can have a pretty good expectation.
The standard deviation? Have you guys calculated the?
No,
oh, okay.
No,
that'd be interesting. Yeah.
I would. It would be very interesting. This is a number I actually didn't even calculate. It was kind of provided to me early on. It just gave me kind of good indication of how patient we can be with capital and what the expectations are around a pre-seed or a seed stage deal. I mean, those stages are pretty, equal to each other, I think, in most ways in terms of how long the company has to go. A pre-seed, and it's all just naming convention anyway. But I fully expect to be continuing to invest with this family office and or others, at least in this asset class, in this stage for the foreseeable future.
That's super cool. What do you think was different about kind of, I guess you're kind of in-house now, so I might describe it, or out-of-house, I don't know. You're at a family office, a single family office, versus being at a venture firm. How has that been similar and different?
Yeah, I think in my case, working for Blue Ventures, which is a bit of a hybrid angel group and fund model. So they started about 13, 14 years ago now with 8 partners who kind of got together and looked operators themselves all had started and sold businesses in most cases. And they wanted to take that kind of operator lens to the market. And so that grew from 8 partners to about 30 while I was there. I was there for 4 years. And that model is very different than a family office model. And part of it is that, there are competing interests. There's a lot more direction in terms of, we're going to be going from place A to place B in the next, few years. I was there while we launched our first dedicated fund. And that was a huge kind of transition for the firm, going from just opt-in deals to an actual fund model. Blue Ventures had done a very good job of building up a portfolio of early stage cybersecurity companies. And one of the biggest holdups was that there wasn't enough capital to work in fast enough time to deploy into some of the fastest growing ones in that portfolio. And so the fund was a natural extension. I think a lot of angel groups that have been
That's
successful.
how we started. I mean, that's why we're called Team Ignite. We were an angel group, effectively, that ignited startups together, and just a couple dozen people I knew. And we grew to thousands of people. And then
that's awesome.
Realized we should probably have some dry powder for the competitive deals, so we can move quickly, because syndicates and angels take weeks to wrap up, a syndicate, and we would lose out on deals, right? Particularly like YC deals. The valuation would change. I'd go out and raise the money. I'd go to wire the money and be like, no, I know I told you 12 cap. It's like a 20 cap now. Speaking of high valuations.
Yeah.
Or like, oh, the round's closed. And I'm like, well, I just raised 100K. I'm ready to wire this money. We committed. Like, no, sorry, the round's closed. Stuff like that.
Yeah.
I was like, I better have some dry powder, particularly for YC companies, to move quickly.
Yeah, and it fully resonates with me too. There, we had very similar experiences, I think, with that. And so, moving from that model where things inevitably move slower, sometimes that's for the best, and sometimes it becomes a challenge, to a place where the only real bottleneck is me, right? I have to manage my time and the portfolio and new deals and everything else I'm working on. I run a networking group called VC and DC, and that takes up some time. But I wouldn't do it if it didn't help the deal flow side, right? It's all part of this kind of time management piece that I certainly work for the family, and I interact with them quite a bit. But it is all based on my ability to time manage and create processes that are going to make me and our group more efficient, as opposed to at Blue, where I had to try to help make the whole organization more efficient.
What is the networking group? Tell me more about that. Sounds cool.
Yeah. So VC and DC is a networking group of close to 500 now institutional VCs. We're based here in the DC area.
Wow.
About 75%.
There's that many institutional VCs there, huh?
So about 75% are somewhere between Richmond and Baltimore, which is kind of how we
Okay.
define the region. And that represents about 200 firms. Now, the way we define firms is kind of up for debate. There's certainly headquarters, there's satellite offices, and then there's just individuals who happen to work here. A lot of folks moved around during the pandemic and found themselves, in Annapolis or DC or Baltimore, and that's where they live now. And so they still then work for some West Coast VC or otherwise. And so we categorize them that way as well. It's a free membership group. We basically just get together for networking events. We now run a monthly kind of happy hour series for investors here in DC. We've started kind of trying to do things in other markets. So we found that Atlanta is a great market for us. North Carolina is a great market. And we will, slowly but surely expand as much as we can while trying to maintain sort of that core mission of supporting the DC ecosystem. And what that means for us is that when we go to Atlanta, we'll be at Venture Atlanta in a couple months, and we're going to bring as many investors as we can so that those Atlanta and Southeast investors get to meet the folks in DC, and so that hopefully we're bringing more capital into the region to deals here, and and vice versa, right? We're able to do a better job of kind of connecting not the markets that aren't New York and San Francisco, right? That type of kind of mentality is kind of how we think about the growth of VC and DC, and the reception to it has been tremendous. We had about 50 investors, maybe in 2017, 2018. And post-pandemic, we threw an event that was supposed to be 50 people, 100 people. And, ever since then, we've grown from, those 100 investors to, 450 and now close to 500 as we come into the later part of this year. We organized as an LLC this year. So, it's sort of been my own kind of little startup, right? I run it with a couple other folks, Bill Collier, who runs a group called Noblest Ventures, and Jerome Smith, who just left Zeal Capital Partners, but all early stage investors.
Right. Yeah, I love that. Yeah, I can relate. I'm in Sacramento, right, or east of Sacramento, like halfway to Tahoe. But I feel like I'm kind of removed a little bit, and I go to SF like pretty frequently because it's only a couple hours away. But yeah, I've been thinking about I need to connect with more VCs here in the Sacramento area. How does the kind of the back end decision making process work at your particular family office? Is it sort of like, okay, you're the bottleneck, but you write the memo and you give it to the actual family, the money people in this case, and then you say, hey, I want to invest in this? Or did they ultimately give the final thumbs up?
Yeah, it is in fact them giving the final thumbs up. I don't think I've brought a deal that they have said no to yet, which has been a lot of fun. But usually I'm not also bringing them a deal for the first time and saying, hey, here's my investment recommendation. You haven't seen this deal yet. What do you think? It's usually I met a great company. I shoot them a note at some point and say, hey, I've been talking to this company. Just giving you a heads up. I think I'm going to be moving forward. And then finally, hey, I've been talking to this company. Here's my recommendation. Let's do I'd like to recommend a 20 or 30K check in this business. And so I get a number back, and we kind of go from there. So it's pretty fluid, but it's a family office, and it's a family office that has been doing this for a long time. But if there is a holdup here, a handcuff, it's that it is cash flow sort of dependent. It's not just a big pool of cash just sitting there waiting to just get depleted until you get all the returns back, right? It has to do with everything else that's happening in their lives.
Right.
And so, we try to, I think this summer we probably will have done 5 new deals, which is, a 3-month span when you're trying to do, kind of 10 to 12, 10 to 15 deals in a year is still an accelerated pace.
Yeah.
And so, a couple of the last deals we did were maybe on the smaller end of those check sizes, just to make sure that we, I kind of
capital
size so we can keep, placing these bets. I talked about the difference between investing in a $12 million or a $25 million valuation. Well, the same thing happens if you put in 20 or 40, right? 20K or 40K.
Right.
Your cash on cash doubles if you put in 40K early than if you only put in 20K. The sort of shots on goal, to keep using metaphors here, is the thing I think that I have found to be kind of the most interesting and important thing for kind of.
Yeah, I'd love to tug on that string a little bit, because that's what I've uncovered looking at this with my financial lens, right? And especially in the early stage, you have this like capital deployed that you're describing, you have the shots on goal, and then you have multiples, right? And I think in early stage, and maybe you can tell me a little bit about your philosophy, but because it's so asymmetrical and there's such a power law at play, how do you balance kind of the shots on goal, getting more at bats, right? Getting more chances to hit grand slams versus putting more wood behind the bat. or wood behind the
Yeah.
arrow, right?
Yeah.
Like putting more cash into high conviction deals. Like, how do
Yeah.
you think about that?
Well, someone just asked me the other day, like, why not just do high conviction deals with more money? And I kind of looked at that and for a second and sort of said, well, if we're going to invest, 500 to 600K in a year, and we did 5 or 6 100K checks, you said at the very beginning of this episode, a portfolio takes 30 to 50 companies to hit it big, right? Like
Yeah,
that's
at
sort of the
least.
number,
Yeah.
right? And so if we're only doing six at a pre-seed or seed stage,
Even
the
if you're the
stages
best
that
investor
I'm
in the world. Yeah.
the stages that I'm investing in at that pre-seed and seed don't change if I write a 100K check. They don't go to a Series A. They don't go to a Series B where maybe the profile, the risk kind of comes down. The risk is the exact same.
Right.
And so if we get six wrong, but then the next four right, the first, we only have six shots. We've got no more shots to do.
Right.
And so, writing those smaller checks gives us an opportunity to then, especially with as early as we're investing, like you said as well, a chance to maybe invest twice.
Yeah.
And before we really get out of our own comfort zone. And so if we can invest at a 5 million and then a 15 million valuation, we've gotten our two good shots on goal, and we had a chance to see a few more cards play. We had to see, a few more quarters of revenue growth, of product build, of, maturity within the founders and the business. And we now feel like that $15 million valuation is one warranted and gives us that second opportunity to have a slightly de-risked slightly.
Yeah. And so you just uncovered another question about reserves versus more shots on goal too, right? Because we just talked about, okay, writing bigger checks into the pre-seed round. But then you also brought in this other question of like, oh, okay, should I reserve capital and double down on my winners? This is another debate I see VCs kind of go back and forth on. Maybe walk us through your strategy on that.
Yeah, we really look at every follow-on as a brand new opportunity. And I can do that. And I say that to founders kind of going into it because we are not keep the lights on capital. And what I mean by that is that we just can't write a check big enough that allows a company that has had 3 or 4 quarters of challenges and high cash burn to go another even month usually, right? Like,
Right.
I mean, if we're writing a 50K check, it's for the most efficient companies in the early stages, maybe that's 2 months. But
and
if you
this is
don't
a hard thing to do as an investor. I want to really tug on this for the listeners here, because there's a bias that's in play in human behavior here, which is like the sunk cost fallacy, right?
Yeah.
Like and it's hard for us as investors because we invested last round, right? So the founder reaches out and they're like, hey, I'm reopening this, or hey, that Series A term sheet fell through, and like, can you wire me some money basically? We just need like, 300,000 to keep us afloat until the next milestone. But like you have to approach it as if like with Zen mind, beginner's mind.
Yeah.
Because if you approach it like, well, I'm in for 25 or 50K already, it colors the whole diligence process. Your decision making is kind of tainted. How do you prevent that from happening?
I think because our checks are so small and because we can't keep them going on for that long, I would say we don't really even start considering it until that six to nine, probably even 12 months of runway is really on the table for the next round.
Yeah.
Or for that bridge round, that extension, whatever you want to call it, that sort of cash extension round. So, if that company does need 300K, we would say we're happy to be, 250 to 300, right? We can be that last 50K of your 300K round. We cannot be the first 50K.
Yeah.
And we can even say, hey, we will commit if you can get the rest of this round put together. Right. And even that is more just kind of like trying to be a good co-investor than it is, for current and future opportunities, and to be supportive. But it is, unfortunately, if we're going to be the first 25K check to write on a company that, that
you're burning 25K a month. Yeah.
Right.
Oof. I just wired you money that's gone in a month, and you're, hand to mouth going out of business here.
Yeah, exactly. And most companies, are burning more than 25K, and
right.
Unfortunately. So, not I say unfortunately, but just it's
in reality.
Yeah, reality. And so, I think we will really only start considering it once the rest of the round is put together. And a lot of times we'll say, you kind of need someone from the outside too. It can't be just everyone, saying, hey, we're going to say this thing.
Yeah.
We'll have a more serious conversation about it if that's the case, but it's a lot harder than if you can get someone from the outside and say, you know what, I now believe in this as a first check.
Yeah. And last question before we go rapid fire, and I could talk to you for hours, and I won't keep you for hours, but how do you think about the future of venture capital as we see this not capital flight, but movement away from the two centers, right? San Francisco and New York. And you've probably done some thinking on this. It seems to me, and I don't have the data to back this up. I think I've seen some anecdotes, but it seems to me that the venture capital is now growing up and developing and maturing as an asset class. And it's no longer a cottage industry necessarily. It's still pretty small comparatively to other asset classes, but it's now done in a multi-geographical way. Whereas it used to be like, hey, you're in SF, maybe New York, and nothing else. And it seems to be, hey, there's 500 people in DC now. And then you got this Atlanta thing happening. And Seattle's definitely a place, and you got Austin and all the other, Singapore. How do you think about like kind of the future of this diaspora of venture capital?
Yeah, I mean, I certainly didn't invent this in DC, but revolutions rise of the rest, I think, is sort of one of the kind of catalysts for this movement, at least the way I think about it here from just my
What
own
was that
kind
phrase? Revolutions rise to the rest?
So
What?
Revolution has a fund called Rise of the Rest.
Oh,
And the Rise of the Rest fund is the thesis around Rise of the Rest is
oh,
simply, it's not SF and it's not New York, it's every other market. And
right.
every other market, there's all sorts of things. If you look at the stats on employee retention in markets that aren't SF and New York, they're considerably better
Yep.
because Salesforce having a headquarters in Indianapolis, a big office in Indianapolis. If Salesforce in the early days had a few bad quarters, no one was jumping to the next startup next door because they just didn't exist. And so
Right.
you actually had better employee retention in these places. Cost of living was lower, and so you could build businesses at cheaper there. Now, talent sometimes was challenging depending on the type of business you were getting, but I imagine it's great talent, and they actually I think they're having a
Well, especially for non-technical roles, right? Like if you think about customer service and sales and all the other back office things.
Yeah, and all these good ecosystems now are view the future as we need to have a sort of a startup path. We need to have support for our startup ecosystems. We see it here in this region with the DC Tech and Venture Coalition with VIPC, which is Virginia's state arm for investing, and TEDCO, which is Maryland's state arm for investing. All of them view the need for investing locally is a really big priority for them. And as I look at sort of like the United States, there's also a combination of the right industry for the right geography, right? Like, B2B SaaS tech in the West Coast probably will always make sense to a degree. But here in DC, I think we are at this real inflection point where regulated industry of all kinds. I mean, you hear about, A16C's American dynamism, right? But you also hear about dual use technology and cybersecurity. Some of the most cybersecurity talent in the country is here in DC, and the biggest buyer in the world for cybersecurity is here in DC. And so all of these things, I think, are playing factors for different markets around the country. And I spend a lot of my time thinking about what this means for DC. And so I really believe that if you are going to build a business that touches or is in regulated industry, which, by the way, is becoming more and more and more, you're going to need to have a presence in DC. And it doesn't have to be, DC proper. I mean, this region in general, because you have all these government agencies, all these government buyers. You've got Congress. You've got, everything here is where sort of
There's a
these
competitive
decisions are
advantage for certain sectors and verticals.
right. And the same reason you
Yeah.
see, a lot of fintech in New York and fashion in New York, and then you see, SaaS in the West Coast. And, these are all things that are sort of in defense and aerospace and defense in Texas, right? In Austin. There's a lot of it here too, by the way, in DC, but Austin has done a great job of that because of all the talent that's there and of all the companies that are there and headquartered there. So I think that's what you're seeing with a lot of these other markets is sort of specialization and then creating ecosystems and economies that kind of get built off of it. You get a big company that gets headquartered there. People leave. They've had a family there, but then they start their next thing, and they come from that world. So you start to see this happening more and more. I'm sure that the pandemic accelerated a lot of this because everyone moved away from some of these hubs and they went to places they wanted to be, and some have moved back and others haven't. But the ones that haven't are now starting to build businesses in these new places based on what that kind of ecosystem kind of can do well.
Yeah, I love that. I would love to talk about that for another hour, but let's do a rapid fire so we can get back to making investments. Sound good?
Yeah, sounds good.
So, we just came out of a pretty weird macroeconomic environment. How have these trends or headwinds kind of influenced how you guys make decisions, if at all?
We try to not be too affected by the kind of macro environment. Certainly, we try to not overpay for any deals, if possible. But we also recognize that some of the best deals are going to command higher valuations. But it's really irrespective of the macro environment. And again, if the thesis is around consistency of deployed capital for the purposes of getting to that 7 to 10 year kind of window, we'll keep operating under that lens.
Yeah, makes sense. What emerging technology that doesn't start with the letter A do you believe will define the next wave of startup innovation?
I would look at data. I think it's not that
Mm,
this is a brand new tech. It's not that it's a new technology. I just come back to the fact that um, it does not start with an A, but the only way that AI becomes useful is with innovative new data. And winners in for the next 10 years are going to be the ones that are able to build and aggregate the best data.
right. Yeah, makes sense. Speaking of AI, what have you seen in the space that you've been excited, and what has looked like noise to you?
Well, one of the questions I think a lot of investors are kind of coming around to is, does Chat GPT-6 make your company better or worse? Every time you talk to a founder about that, they will say, oh, we get better as Chat GPT-6 comes around. But the way they answer the question, I think, is really important. So what you hear is that our team has 20, 30, 40 years of experience in this industry. And so with the advent of Chat GPT-6, our product gets better, and we're the ones to do it because of all our experience. What I hear is that you have 20 to 30 to 40 years of experience, but when ChatGPT 6 comes out and is trying to take over your space, your industry, it has probably 100 million years of experience, right? Based on all the
Yeah,
data and
yeah,
that it has and the way it's been training its models. And so you really can't win against that. And that's why I come back to data, right? It's about having data that an OpenAI, that an Anthropic, that these big models don't have access to, and that you're able to create a defensible moat around, because otherwise you're going to become a commoditized product very quickly. So it's your ability to create something outside of um, an improved mass market model.
yeah, yeah. And I'm starting to see some demos that are just absolutely jaw dropping. Where these agentic workflows can basically log in as you and go do tasks and go check in with you if it gets stuck. And,
Yep.
like agents as a service or tasks as a service is going to really change what it means to have a SaaS kind of business, right?
Yeah.
Because SaaS fundamentally it exists to like kind of have inputs and outputs and like configurations of data, right? And storage of data. And if the agents can crawl that data and do the things for you, it's gonna leverage human talent like in a crazy way we haven't seen probably since the internet or PC revolutions, and probably even more so. What are some of the biggest challenges you're seeing right now for early stage companies in the current market?
I think fundraising in general remains, really, really challenging. There's still this bifurcation in the market between uh, deals that are happening at sort of a sub $6 million valuation, and then kind of over 10, 11, 12. And there's not much happening in that kind of middle range. And so there's sort of the question mark of, well, we talked about this earlier, but okay, valuations are too high above 12, and they're kind of, what's wrong with you below 5?
Yeah,
And it's not a fair assessment at all times. Sometimes it's very rational founders who just want to get back to the business of building their business, and they want to find a good partner and do that. But I think that threading that needle right now, given the kind of macro environment, is really challenging. And so,
yeah,
proving that your value is either high enough and then meeting that. I mean, I think that's going to be the really big thing we see with anyone that's in this split market where you've got low valuations and high valuations. It's, well, what happens in 12 to 18 months when you go to raise again, and you're not worth the 15 or 16 million dollars because you haven't hit 1.5, $2 million of revenue that you expected to in the next 12 months. So, you continue to see, I think it's Carta data that keeps showing me, record numbers of companies are still shutting down, quarter over quarter, because, those valuations from 2021 are,
yep,
we're now 3 years after that, 2022 as well, obviously early 2022. Companies just aren't able to raise, and that vanilla story of up and to the right from Series C to Series A to Series B is just not as taking place. And the other thing you see in the market, which is making it hard for earlier stage companies, I think, is that a lot of Series B investors don't really like what they're seeing. The metrics aren't there, and so they start going
right,
towards Series A. And the Series A investors can't compete with Series B investors, so they start investing in the Series Seed, which is driving Series C valuations up because Series A investors have to write a $2 million check, not
At
the
least. Yeah.
half a million to $1 million check that was relevant for a Series C. And so dilution just requires valuations to jump.
Yeah, I love that. I love that assessment. And one of the things that's challenging, I think, if you're a founder or a VC advising them, is how much should you raise, at what valuation, and what are the milestones, and how much runway does that get you, right? Because you don't want to raise too much at too high of a valuation, and then you're kind of stuck, right? Because you didn't hit your milestones. You burned 5 million and you got 500K of ARR or 1 million of ARR. That's a really bad place to be.
Yep.
And conversely, you're raising too little, and you kind of keep doing these 300K, 500K rounds, you're not hitting enough momentum to really get the right investors and get enough traction. So yeah, it's thread the needle, like you said. It's tough. What are your thoughts on remote first startups and their long-term viability?
I think it's got to be company by company dependent. I mean, I think there are leaders and founders out there that are going to be able to make that work. I think at some certain level of scale, I don't know what the right exact scale is. You're going to have hubs of people that can get together and do things in an office space. But I think that as we talk about startups and pre-seed and seed and maybe even Series A, basically just being MVP companies, right? Like you don't need to be in an office to build your MVP company. You need people that are going to be highly driven and efficient wherever they are. And it's going to be when you start bringing in all of that support staff, it's when I say support, I mean, it's more junior folks that are maybe first time in the industry that need to understand the sort of apprenticeship of whatever role it is that they're building and they're working in that learning environment. But if you have good practitioners, good operators who have been there and done that and understand what it is they need to do, that is your MVP company that should get you through a pretty, late stage, relatively speaking, before you need to really be in person. It's all about bringing in new people that requires that kind of in person.
Right. Well, where can people get in touch with you if they want to, I guess, pitch you for money or get in touch?
Yeah. Well, our website, JHHVC, has a drop link always. You can honestly feel free to shoot me an email at Matt, M-A-T-T, at jhh.vc. And for any, founders or investors interested in just signing up for the kind of mailing list for VC and DC, which has tons of, events, mostly here in the DC region, but expanding, and also just we'll be creating more connections for founders and investors to connect with each other. In the future, not quite there yet. You can do that at vcanddc.org.
Well, thanks so much, Matt. Could have talked to you for another hour or two. We'll definitely have to have you back on at some point.
Yeah, Brian, thank you so much. Really enjoyed the conversation and look forward to continuing to work with you.
Yeah, likewise.